That's the value of simply being able to hold real estate in the long run, right? In the long run, time heals all wounds in real estate. And as long as you have a good asset and as long as you are financed appropriately, in the long run, you will do well holding cash flowing real estate assets like apartment buildings.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I got Drew Whitson, my partner with Endurance Capital. Drew, how are you doing today?
Hey, good morning, Todd. Doing well.
Awesome. Drew's up at the cabin, spending some time up there, but it's a work cabin. So even though you get a little play, you spend plenty of the time working. So
that's right.
I get jealous that you're up there all day, because it would be nice that, just to be at the lake and be able just being, I think, outside of your house sometimes is kind of nice.
It's refreshes. You get a little kind of refreshed perspective and although it's the same work, though, you jump online, having the same meetings, the same conversations with the same people. But yeah, it's great.
But after work, you get to play a little bit. I'm sure a little bit during the day, but
occasionally.
Yeah, yes. Occasionally. Well, cool. Drew, we're going to talk about a kind of a deal that you and I did together. We purchased it in 2019 and we still own it today. It's a syndication. And when most people think of syndications, they think, you're going to buy, and most of our syndications have been this way too. You're going to buy a building and it gets sold within 2 to 4, maybe at the most 5 years. And that's just kind of how things are typically done. And so keeping something, this is now just over 5 years, is kind of rare.
Yeah, it's one of the longer holds that I've had is given the rise of sort of the cap rate, the rise of values with the cap rate compression the last couple of years. For a lot of investments that we made, it made sense to exit early because we could hit the return goals that we had, originally set out for our investors. And so there was a lot more just velocity. This is one of the deals that we bought before the big, cap rate compression, the rise in values, but we've continued to hold on to it, and we've capitalized it in a way that it makes sense for our investors to continue to hold it for a few more years.
Do you remember how much we bought the property per door?
It was $39,000 per door. Yep, it was so the property it's in Memphis, Tennessee. It's kind of like it feels a little bit like a townhome development, not exactly, but it's a pretty spread out. So it's not just a big giant building, right? So it's kind of spread out. It's got some rolling grass hills. We bought this from an investment company out of New York that had paid, I think, just a couple $1 million out of receivership. It had been foreclosed on. They bought it and they flipped it to us. And $39,000 per unit was unbelievably low, even for that time. But one of the reasons that we got this deal was that I happened to be in Memphis already. I owned an asset with another investor, and we were just asking around, talking to the brokers, and this had fallen out of contract with another group. And the sellers had said, look, we know we're giving you a really good deal. We know that we are giving you a good deal, but the way we calculate our returns, every day that we own this, our returns go down. And so they said, we'll give you a screaming deal, but you got to close on these terms with this timeline. And we just smiled and said, absolutely. And we got that deal done. So we happened to be in the right place at the right time, simply talking to people. We were able to be organized enough, and we have the right investor base that we could move quickly. So part of the value that we started out to our investors is the fact that we could get this at such, we bought it at just a phenomenal price.
Yeah, bought it at a great basis. And from there, it was kind of all upside, right? But get back to just getting that deal, and that just goes to show you the power of, networking and getting involved and being proactive with brokers in the market that you're in. And if you're not going to do that, you're not going to find the deal. If we would have just been, kind of communicating with the broker, I didn't get the deal. And I guess I wasn't super active in the market at the time, but a lot of other people didn't get that deal, right? A lot of other people didn't didn't even have an opportunity at it. And you had the opportunity because you were there, you're in town, you're talking, you're asking about what's going on in the market, you're asking about the type of deals that are happening. And that's how those types of deals happen. It's crazy to think that if you weren't there at that time, you likely would never have seen that deal. And there's another deal I got well, two other deals in Lexington, Kentucky that I got. It was both the same thing. I was there that day. And the one deal I got, I was there that day, and we actually went and saw a different property that was listed. And I'm like, hey, you know what? This is okay, but I want something a little bit bigger. What do you got? And I ended up putting an offer on the 46 unit and the 84 unit right next door. I was hoping to get both of them. I only got the one, but it was just, I wouldn't have got it if it wouldn't have been for that day. And then the next time I was in town, I'm like, hey, what else do you have? I need something to kind of, piggyback off of this one, and got another property. And it's just really being proactive that's going to get these properties.
Yeah, I mean, I tell people all the time, if you are an active real estate investor, there is nothing that is better than being there in person, press and flesh with the brokers, walking the properties, because there's a lot of people out there that can call and email and Zoom, but really nothing replaces the ability to build trust in a relationship with a group, like seeing someone in person, especially for a group like us that's outstate. We can spend a lot of time, but if we don't ever come into their city, we don't ever come and meet people in person and feel like we are really actually a committed, serious buyer, we're at a disadvantage. So yeah, I always tell people there is no, it's never not valuable to go in and meet these brokers and go into the market you want to be in, just to get more familiar, just to become familiar with the neighborhoods and who is doing the transactions, right? And I had probably gone to Memphis 5 or 6 times before I got my very first deal there, right? At the time we bought this property, I only had one, right? So it took a long time of building those relationships, because there's a lot of people from out of town that are just kind of tire kickers, right? And so that's really what it takes to separate yourself from other buyers, and build that trust with the people who control the deals in those markets.
Yeah, I mean, how many people these brokers talk to that they got people that are, oh, we got tons of money and we're coming from New York, California, you name it. I mean, it's just constant. They get 10 of those calls a day, and they don't know which ones to take serious and not. And they probably take most of them not very serious until they actually meet the people. And they're like, okay, like these guys took the time to actually show up into our market. Maybe they are serious. And then they meet them the second, the third, the fourth time. They're like, okay, yep, they want something. They're hungry. So yeah.
I remember, Todd, I remember the moment that they said, because we were asking them what else might be available, and they said, we know this property has fell out of contract. They said, if you can raise $3 million, I think this would be a great buy, because it had already been walked, it had already been underwritten. And of course, at that point in time, I had never raised anywhere near that amount, but I just kind of smiled and said, yeah, absolutely. That shouldn't be a problem, right? And I think an hour later, I was on the phone with Todd saying, Todd, I got a great one here for you, man. You should partner with me on this one. And I think that was the first deal that we partnered on.
Yeah.
And we put that together, I think, pretty handily. But I just said yes to what was a good opportunity, even though in that moment, I wasn't sure how I would come across with $3 million of equity 5 years ago.
Yeah, that's how relationships are are formed. And it's funny, I was nervous about doing the deal. And the main thing that I was really nervous about with this deal, it wasn't so much the business plan and kind of the underwriting, that type of stuff. What I was really the most nervous about was the bridge debt that we ended up taking on. So this property couldn't qualify for agency debt. It's out of town, so you're not going to get a local bank to bite on it. So the option for financing was bridge debt, and I was not excited about bridge debt at all, and finally got on board, and we ended up getting actually pretty good terms overall for the time. But there was renovation needed, so that was the other need for the bridge, is that Drew, do you remember how much did we put in? Was it 2 million about?
Of renovations?
Of renovations, was it 2 or 3
Correct.
million?
Yep. About 2 million. Yep.
2 million.
Yep.
And so, yeah, so we tied it up with the bridge debt, and it ended up working out because we were able to refinance it later, which we'll get to. So with the renovations,
Yeah.
Go ahead.
No, I was gonna say, it's amazing how times have changed. I think we were pretty disappointed in that we had to buy an interest rate cap. I don't know if you
Oh
remember
yeah.
having to do that, but I think we spent like $25,000 or 30,000 on an interest rate cap, which I think in today's market, that same interest rate cap is quite literally 20 times the price as it would have been back then. And we didn't think that anyway. We thought we were just throwing money away, but boy, we were getting a cheap risk option back in the day. So it really shows you how this kind of financing has really evolved.
Well, and I don't think we ever utilized that rate cap, right?
Nope.
I believe that the rates
Stayed
just
low.
continue to stay low and probably got lower as we went. So um, we were able to complete, all the capex, and so it was fairly light considering all considering. Quite frankly, like if you do that same renovation today, prices are considerably higher. So you're probably talking 40% more, but most of the interiors cost us around that $8,000 a unit.
8,000. Yep.
Yeah. And again, today that probably would be, 12 to 14,000, somewhere around there, for that same type of renovation. And then we did some interior or exterior improvements as well. And we just did another round of exterior improvements, in fact. So we'll go to kind of what we've done. So here's one of the things that I look at especially at that point in time, I wanted to see what this deal would look like long term, and I want to make sure it's actually good long term. But I also want the prospect of short term too. So it gives us flexibility. That's what I like the best on a deal where, Drew, we can sit here and go, hey, look at this deal. If we sell this in 3 to 5 years, this is our IRR. 3 years, here's our IRR. 5 years, here's our IRR. It's really attractive. Like this is a really good deal, right? We've got some equity that we can build up. But when we also go, hey, what happens if we keep this long term and we keep this for 10 years? What does it look like? Do we have really good cash flow? And this was that type of deal where you could say, well, we could refinance, and we didn't really present a refinance necessarily to our investors, but internally I ran numbers. What does it look like if we refinance this property and keep it and hold it? And this deal worked on both ends, and that's not the case for a lot of deals that get done. And so that's definitely something I liked about this deal.
Yeah, it was a good size, right? It was a good size from 200 some units. It was a good opportunity in terms of it was a newer built asset, right? So you weren't worried about, something built in the mid 80s. You weren't super worried about some of the infrastructure falling apart. So it had a really lot of good characteristics around it that gave you a bunch of options, right? And that you felt there was some things that you could mitigate the risks long term.
Yeah. And so when did we do our first mortgage or refinance on it?
It would have
Was
been it was 2 years ago in October,
Yeah,
right?
so it
So
was
we had our
2022.
bridge debt for about 2.5 years, and I think it expired after 3 was our original term. So,
Yep.
and then so October of 21, we refinanced into a fixed rate product, and I think we're at
2.7,
2.6%.
2 point, yeah, something like
Eight.
that. 2.6, 2.7, somewhere around
Yep.
there. And we're
Interest
locked in
only.
for 7 years of IO. Is
7
that
years.
what we got?
Yep.
So 30-year AM, which doesn't really matter because we're locked in to IO. So we're locked in for 7-year IO at let's call it 7%. So somewhere around there. And so our mortgage payment dropped drastically from the bridge debt to the mortgage payment. And we kept that. And at the time, we just said, well, this just makes sense, right? This just makes sense for cash flow. We didn't decide then that we're going to hold this forever. And we still don't, it's still not the case, but we didn't decide then we're going to hold it long term. We just decided like we got to get out of this bridge debt as soon
Yeah.
as we can. Very glad right now we did, and lock this rate.
Yep. Yeah, I think our mortgage dropped by, I think it was a third. So it went down by 2/3. It was pretty astounding
Jeez.
how much. And as a percentage of our rent, it was just minuscule, right? It was single digit percentages in terms of what we were actually paying.
Yeah, and that was a
Um,
cash neutral refi,
yeah, it
right?
was cash neutral too, which really helped us. I think we went to a very low LTV. And so it really sort of set us up to generate, one, a ton of cash flow for the investors. It gave us a really long runway in terms of what we wanted to do with that property if we wanted to sell it. When you have a bridge debt, right, that is trying to get you from a high risk, capital intensive need to a stabilized position. So as soon as we hit that stabilized position, we wanted to get rid of that expensive bridge debt and get into something that reflected the stability and the quality and sort of how the property was full and in good shape. So that was, you're right. We tried to exit that as soon as we got to the point where it's sized well to some more permanent financing.
Yep. And we looked at, so there's a couple options there when the bridge debt is coming due. You could refinance like we did, or you could say, well, let's just sell it right now. And we looked at it, we thought about it. But when you're looking at the total NOI of the property, the cash flow, what's going on there, we were able to refinance that property and provide amazing cash on cash return to investors. And as I talked to and you talked to some investors, they all wanted the cash on cash return. And I got several investors that says, please don't sell it. Like, please don't sell. Like, the cash flow is amazing. Please don't sell this. Where can I get that cash flow? And then I got to find another property to put my money into. And I got to pay taxes. Like, I just want you to continue to cash flow this building. And so for me, it made sense. Like, okay, well, let's hold it, and it's running properly, and we can continue to improve it quite a bit, which we have even since that refinance.
Yep. Yeah, I think at the time we did the refinance, I mean, interest rates on savings accounts were zero, treasuries were close to zero. There really wasn't an alternative to where to put the cash to work. So yeah, it was resounding from our investors that as long as this thing has continued to produce cash, it continues to be stable, let's hold on to it, right? I think we continue to sort of see the upside. I think one of the amazing things, Todd, is when we looked at our original business plan versus where we're at today. And I think you have some of those numbers, but we're significantly above from the rent side that we ever expected to be when we launched this deal.
Yeah, I mean, we are, obviously every single month changes, but if you just look at some of the snapshots on the month, we're projecting our pro forma projection on income was, roughly 180,000 today, on a monthly basis. We're making right around that 210,000, again, it varies, but significantly higher than what we originally projected. Now, on the flip side though, Drew, we got to be honest, our expenses are also quite a bit higher. Our net operating income overall is greater. But our expenses are definitely higher, property taxes, insurance costs, those have all gone up drastically, payroll, all expenses. I think I saw a stat the other day, expenses on apartments are up like 8.2%. They were up 8.2%, I think, 2 years ago. And then this year they're up like 7.1%, or this last like year to date. So expenses are up drastically, but the good thing is income, like I said, is far exceeding where our pro forma ever was. And so overall, our net operating income is definitely better than what we projected. And so, and also, when you look at valuations, we could sell this for significantly more than what we projected as well, because cap rates have compressed. Even when we bought this in 2019, we see people are talking about cap rate expansion now. And maybe we're back to 2019. So maybe it's not quite that, big anymore, but the cap rates really compressed there for a while. But because of our increase in NOI, the building's worth more than what we projected.
Yeah, significantly more. I mean, that's the value of simply being able to hold real estate in the long run, right? In the long run, time heals all wounds in real estate. And as long as you have a good asset, and as long as you are financed appropriately, in the long run, you will do well holding cash flowing real estate assets like apartment buildings.
Yeah. And this one, we were ready to sell it. and we would probably sell this building honestly at any time if the right offer comes around and it makes sense. But we were looking at well, we had a potential buyer on it, and they did due diligence, and you know, they ended up not liking kind of the loan. They liked our loan that they could assume. They didn't like the option of the loan that they would be getting on top of our loan. Because, like you said earlier, we had very low leverage. And when we're going to sell it, we had extremely low leverage. So they wanted a supplemental loan on top of it, and they weren't getting the terms that they could really that they wanted that would make the deal make sense for them. So instead, what we did is we put a supplemental on it ourselves.
Yep.
And you worked through that supplemental. So what did that look like?
Yeah, so the supplemental allowed us to go up to 65% LTV, loan to value, on our property. And the amount that we were able to add as a supplemental was equal to the amount that our investors originally put in. So we took out about $3 million. The interest rate was higher, right? So our original, the refinance debt was 2.8%. When we added in a supplemental, which was a smaller, higher interest rate, I think it blends out to about 4% interest on the entire debt component, and we're still only 65% LTV. So we were able to get a little bit more equity out of the property. We returned all the original capital back to our investors. The property, in terms of from a leverage standpoint, from a cash flow standpoint, is still really strong. And so I think that strategically made sense to give some tax-free money back into our investors' pockets. And we've continued to, we've made some additional, repairs and improvements, but then continue to make, distributions back into, back to our investors. I think even this quarter, we spent out another distribution for the first time since doing that refinance in 23.
Yeah, so we took a few months and did a bunch of capital improvements to the property. So what we looked at is we said, hey, if we're going to keep this thing for the next couple of years, what do we need to do to the property to make it look good and operate well and keep our expenses down? So we went to the property, we walked the property, we actually took the due diligence. So our property manager that's currently managing it was going to be the property manager for the new company that was going to be owning it. And so they did due diligence with them, and we took their due diligence list and we worked through that due diligence list and said, what items are necessary for us right now? And so we replaced some roofs, we did siding, repairs, and just cleaned up the siding. We're still going to be doing the landscaping. We haven't done that yet, but a lot of tree removal and tree trimming, work to the gates, I can't remember what else, maybe gutters, but just some, kind of big ticket capital improvement items that we can check off the bucket or check off the list, so we don't have to have that just hanging over our heads still.
Yeah, we said if we're going to own this for 4 more years, which we're really committed to now that we got the supplemental, what kind of things do we need to do to make sure the property continues to perform at its best, make sure it looks good, make sure it's attractive to tenants. And that's sort of the last couple of boxes that we check. So I don't see a scenario that we're not going to hold this for several more years. Right? Certainly an offer could come along. But given the way we've structured our debt and what we've communicated to investors, I expect to continue to own and manage this for several more years and continue to distribute the positive cash flow that we should be creating with our property manager.
Yeah. So the big thing too with that is for us right now, I think it's easy when you're going to own a property longer term to get lazy with the property. And that's something we're trying to make sure we avoid, is getting lazy with the property. That's one of the reasons why we did those capital improvements. We don't want to get lazy with the property. We want a good, well-performing, good-looking property. We want that to continue. So that's something I think is really important for us, is we have to stay on the ball. It's really easy if you're not getting ready to sell. And so we're not getting ready to sell, to allow the rents to kind of to slump a little bit.
Yep.
not keep up with the market. It's really easy to not be on top of your expenses, those types of things, because we're not thinking about selling. So we're not watching the bottom line. But that's something again that we're trying to be really, just continue that effort. What's the market doing? How much can we push rents? Where's our occupancy? How high can we get that occupancy? And then really looking at expenses too.
Yeah, I mean, we have multiple, couple calls a month with our property manager. We're always asking for rent surveys. We spend time reviewing the financials. So yeah, you're absolutely right, right? It's new transactions or buying or selling is always exciting. It brings a lot of attention, but just the steady run state is really where in the long run, you're going to make your money. You're going to do well for the investors. If you're making sure that your rents are competitive, that your property is staying completely full, right? Where you're starting to ask the right questions on the expense lines to make sure that you are running the property as efficiently as possible, right? So you don't want either yourself or the property manager to become complacent. You always want that attention from the staff, right? To make sure that we're getting the absolute most that we can out of these properties, even if we intend to hold them for several years.
Yep. Yeah. So the beauty is now our investors are getting technically infinite return on their investment. Right. So
Yep.
that's a nice thing. They're continuing to see that cash flow. They will eventually see the profit from a sale whenever that does happen. Like you said, right now we're likely committed to the, close to the end of the loan terms. But we're also not in a forced position either way. We've got a ton of equity. We're going to continue to grow that equity. And so we're not in a forced position if in, 4 years, let's say the market all of a sudden crashes. We're not forced to sell. We can do, we can be flexible. But in 4 years, if it feels really good, we'll sell. So,
Yep. Yep.
we've got options, with the property. And that's, again, like I said at the beginning, that's what I love. I love real estate when you have options, when you're not forced into one strategy and that strategy is a higher risk, right? Strategy where you have floating rate debt, you have to sell. If you don't sell, it's a bad investment.
Yeah. Yep. Exactly. And one of the things I liked about this deal was that it really put us on the map in terms of large apartment transactions. So it helped us build out credibility with the larger. I think the broker that sold this to us is part of one of the shops that do some of the biggest, most transactions. And that really sort of gave us an insight into that market, right? And we were able to make additional acquisitions in that marketplace and build up our relationships with property managers and start to, sort of carve out a reputation. And we've done, that was the first of many deals that we did in the Memphis market after that.
Well, and we kind of became known as the go-to group when a deal falls out of contract.
Yes.
Right. And so
Yep.
we bought a lot of deals in Memphis and Kentucky that we weren't the highest bidder. We were when the deal falls through, they go, okay, who can close on this deal? And
Yeah.
so we're the call. And so that's nice to get those transactions, especially, when you get that first deal that you close that was under contract, that didn't close, and then it comes to you and you can actually close on it very quickly. You're known as that group. Like there's the
Yeah.
group that we're going to call.
Yeah. I mean, brokers like to get the best price they can, but they don't get a nickel if nothing transacts, right? And so very often we'll tell them, look, I can't give you top price for this, but we will close, right? And
Yep.
we were able to do that. I don't think we had any failed transactions in the Memphis market. And yeah, you're exactly right. After something fell out of contract twice, sometimes three times, I'd get sort of this call and say, all right, can you just take a look at this and tell me what you can do, right? And so that was sort of our way to get that credibility and that relationship with those brokers.
Well, and a broker, like, look, they're going to get the first chance. If they get the first chance to sell the property and it doesn't sell, they know that if they do get that second chance, they got to get it closed because there's likely not going to be a third chance. And if there's somehow a third chance, they better get it closed because there's not going to be a fourth chance. Like the seller's not going to keep on going back to them and go, okay, who's next? You haven't performed for me, but you seem like a nice guy. Who's next? Like, no, they're not going to deal with it. So you like you said, they don't get paid if a deal doesn't close. So they want the best price, but they want to get these deals closed.
Yep, absolutely.
So, all right. Well, that's what else? Anything else that you want to cover on this deal? Anything unique? I don't remember anything else unique.
No, I think that's it, right?
Cool.
That's kind of the whole story. I think there's more to it. I'm excited to see what happens in the next couple of years and get to go full cycle with our investors. But yeah, it's been I wish we could do more of these, Todd. I wish we had more of these under our belt.
Well, I feel like that when you talk about like lessons learned with the kind of the deals we've done together as a group and deals you and I have done separately, I feel like that's a big lesson learned as I take a look at this property versus some of our other properties. And you just look at the strategy overall and what we did here. I feel like we're going to be doing more deals like this one, with similar strategies. Of course, nothing's exactly the same, but with similar strategies and saying, all right, how's this deal work? Look, the best thing about the deal is it's got good, strong, super strong cash flow. And so it just provides you so much more flexibility when you have really good performing properties. Just does. So I think this deal has taught us lessons that we like this type of asset. And it doesn't necessarily mean every deal of ours is going to be kept for, 9-10 years. But it does mean, I think most of our deals, if not all of them, will have the ability to be kept for 9 to 10 years if we so choose.
Absolutely. Yep, I agree with that.
All right, man. Well, appreciate you joining me, and you have a fantastic rest of the day.
Thank you. Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.